Hi there everybody and welcome back to another video. Today I would like to talk to everybody about something that I've noticed happened in the bond market recently, and well, if you're looking at the screen right now you can see exactly what I'm talking about. So I want to talk about this event that occurred. So with that said, let's get started with this video. Now guys, before we actually get started on what occurred with the US Treasury bonds, for all of those of you who may not know what a bond is, I actually have the definition right here straight from investor.gov. Essentially, what are bonds? A bond is a debt security similar to an IOU. Borrowers issue bonds to raise money from investors willing to lend them money for a certain amount of time. When you buy a bond, you are lending to the issuer, which may be a government, municipality, or corporation. In return, the issuer promises to pay you a specified rate of interest during the life of the bond and to repay the principal, also known as face value or par value of the bond, when it matures or comes due after a set period of time. So to simplify it, think of a bond like your friend wanting to borrow $100 from you, but you don't necessarily trust your friend. So what you do is, okay, your friend says, I'm going to give you this note, this paper that guarantees that I'm going to give you your $100 that you let me borrow plus a certain amount of interest within this time frame that I am borrowing this money for. I promise to pay it back. Don't worry about it. So that is essentially what a bond is. Now, as it says here, guys, the government may issue bonds, so does municipalities as well as corporations. And the main thing that I actually want to focus on right here, it is the government, because if you all saw the beginning of the video, well, the US yield curve inverts again. What is it telling us? Yes guys, the US Treasury yield curve for Treasury bonds has actually inverted once more, and actually it is significantly worse than last time. So what do I mean by inverting? Well, remember what the definition was. A bond has a maturity date that essentially after that bond matures to that date, the initial principal has to be given back plus all of that interest payments that that bond was held for, right? So as you guys can see, the maturity date really does depend as to what the terms of agreements are, but when it comes to US Treasury bonds, there are a couple dates that each of these bonds mature. The 3-month, the 6-month, the 12-month, the 2-year, the 5-year, and the 10-year, and the 30-year. So normally guys, the more years a bond has for maturity, the more of a percent yield you should be getting off of that money that you lent to the government, right? Because the more years that the government holds that money for, essentially the more risk there is. So you would want a significant amount more in returns because you are giving the government way more time for them to hold your money. So essentially, this is an example as to how this would look like, right? So for the 3-month, you would gain at around like 1% yield. Again, this is just an example. For the 6-month, it will go a little bit higher to like 1.25. For the year, it would be 1.75. For the 2-year, it'll be 3%, 5-year, 5%, 10-year 8%, and the 30-year 11%. And this is essentially what you would get if you were to chart this. This is what is called the yield curve, right? This is a nice healthy yield curve, and this is what we should expect. This is what we should expect when the economy is actually in pretty good shape. However, guys, what currently is happening today, it is essentially this. This what you're seeing here, guys, is the current yield curve of the United States. So as you can see, this is pretty much all over the place, right? The 3-month in this case starts at 2.38%, which is good. The 6-month is now 2.9. Okay, a little bit higher than the 3-month. That makes sense. The 12 months is 2.96. However, guys, the 2-year, it is 2.97. The 2-year and the 12 months in this case, guys, is essentially the same at this point. This is not something that should be happening. The 2-year should be significantly higher than that of the 12 months. But if we actually keep going with this, looking at the 5-year now, the 5-year yield on the Treasury bond, guys, is 2.84. The 5-year yield is actually lower than that of the 2-year, than that of the 12 months, and that of the 6 months. This is just saying, guys, that a lot of people are buying into the 5-year bond because the price of a bond and the yield of a bond are actually inversely proportional. The higher the yield goes, the price of the bond's actually decreasing, right? Meaning people are selling. The lower the yield goes, the more people are buying into that bond, therefore the price is going higher. So the reason why, guys, people are selling the 6 months bond and the 12 months bond, therefore bringing the yield higher, and buying into the 5-year is because people are foreseeing that in the next 6 to 12 months there's probably going to be something significantly bad happening in the economy. So that's essentially what this is saying, but it actually gets even worse than that. But now looking, guys, at the 10 years, this gets significantly worse. The 10-year yield, guys, is 2.75%, lower than that of the 5-year, lower than that of the 2-year, lower than that of the 12 months, and lower than that of the 6 months. In fact, we are actually getting significantly close, guys, for even the 3-month to invert with the 10-year, which is, again, not good. You can see here by this graph, this 10-year yield, it is significantly lower than anything here that you see, right? And now looking, guys, at the 30-year, the one that should be the highest yield out of all of them, we see that, well, it is higher than the 10 and the 5. However, it is the same as the 2-year and that of the 12 months. And the 6 months is getting very, very close to passing even the 30-year as well. So as you can see by this yield curve graph, guys, this is all over the place, right? Compare that to what it should look like, which is this. This is not looking good in the slightest. And, well, the reason why I'm making a video on this whole entire subject is because the yield curve inverting is a really good indicator as to if people foresee something bad happening in the future. As I said, remember, yields and prices are inversely proportional, right? So the higher the yield goes, the price is actually dropping on that bond, meaning people are actually selling that bond, right? If people are buying into that bond, then the yield actually comes down. So the fact that on the 6 months it's 2.9% and on the 10-year it is 2.75%, this is pretty much just saying that people are selling out of the 6 months bond and even the 12 months bond and putting it into the 10-year because they foresee something really, really bad happening in the next 6 to 12 months in regards to the economy. Now, a lot of people say that usually when the 2 and the 10-year invert, this is calls for a recession, right? That is not necessarily the case, but it is a really good indicator that tells you that something may be wrong right here. So that's pretty much all I wanted to talk about in regards to this topic. This is, I believe, now the second time I've made a bond video. It's not something I really get into, but it is definitely interesting because, well, it is an indicator that people tend to look at, and usually people that invest in the stock market, if they see something bad happening in the economy, they usually tend to sell out of stocks, making the stock market go down, and then going into the bond market, into the later bonds like the 10 and 30-year for security. So that's just pretty much one way to look at it, guys. All I'm trying to say is that be careful because by the looks of this yield curve inverting, once again, this is not the first time it's happened, we are probably heading, guys, into some really bad times in the next 6 to 12 months. That pretty much does it for this video. Like if you like, comment, subscribe. Really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out and be on the lookout for the next video.